Right, this question wanted a free cash flow valuation on this particular thing. So it said, assume there'll be an immediate cash inflow of 800,000, and we seem to have a 5-year project going along here, don't we? Okay, so we open up our spreadsheet, and we know it's for 5 years, so we can go 0, 1, 2, 3, 4, 5. And immediately I get some cash inflows. Straight away it says, that's year 0, isn't it? So cash inflows of 800. So far so good. Then I've been given after-tax profits of all these figures. So after tax is what I want. I can ignore interest for now because it's not mentioned in the question. So go to my spreadsheet then, and I'll say after-tax profits. So we know that the additional investment equals the depreciation, so I can ignore both of them really. Okay, so that's that. And then it says from year 6 onwards, after-tax profits and the additional investment would be expected to be the same as year 5. And the cost of capital is 12%. So back to my spreadsheet again. So what we're saying is from year 6 onwards, they're going to be making 558 every single year. That's what we call an annuity. To get to the value of an annuity, divide it by the cost of capital, which in this case is 0.12. That's the annuity. It's happening from the end of year 5. So I'm just going to say, right, from the end of year 5 then onwards, I've got that 4,650. And that's it. I've done the question. So what I'm going to do now is I'm going to total it all up. So I want the sum of that down to there. Done that, and then wait for the little cross there, drag it all across for the 5 years, and year 5 is included year 6 onwards, okay? Now I can just discount it, and if you remember, discount down. So on the present value of these free cash flows, I use the MPV function, so equals MPV, open brackets, first of all put in the rate, 12%, comma, then put in the range. Remember, you never include year 0, so year 1 to year 5, close that off, and then your total valuation using free cash flows would be that plus the 800 to begin with. 5276.53, and you're done.